This video discusses receivables disclosures and ratios using PepsiCo's 2017 annual report. If we look at PepsiCo's balance sheet, we're going to first have to look, noting that receivables are highly summarized in one line on its balance sheet. We're going to look at the accounting policy footnote, and we're going to look on the balance sheet first before going into other footnotes. So accounts and notes receivable net of the allowance for doubtful accounts at the end of 2017 for PepsiCo is about $7 billion. How are they accounted for? What are the accounting policies? Looking back at note 2 on significant accounting policies. Within revenue recognition, they tell you they're sold for cash or on credit. And these credit terms include pay within 30 days in the United States. Net 30 might be a terminology used in your book, and pay within 30 to 90 days internationally, and they may allow discounts for early payment. For instance, you might see something like 1% if the receivables paid within 10 days, but you must pay it within 30 days. That's 110, net 30, as your book would describe it. Now, we said that every time you grant customers short-term credit, there's a chance they won't pay you. So they have to estimate an allowance for uncollectible accounts and at the same time bad debt expense. So they make this estimate before the accounts actually go bad to match credit sales with bad debt expense based on their experience with past due accounts and collectability, aging the accounts receivable, how long are they overdue, and their analysis of particular customer data. Bad debt expenses actually in the selling and general administrative expenses in the income statement. So if we want to look in note 13 for supplemental financial information, in addition to supplemental financial information on inventories, part of it also talks more about other balance sheet accounts like these receivables. And first we note the gross amount that people owe us on accounts and note receivable. Most of these receivables are trade receivables, meaning to customers. Other receivables could be things like loans to office or short-term loans to officers, but they're relatively small. So the gross amount that is owed to us on receivable is $7.15 billion. The allowance for uncollectible accounts is about $134 million at the beginning of the year, and it goes down to $129 million at the end of the year. Well, let's try to think about why. So when they say net receivables, net of the allowance for uncollectible accounts, it started out at $134 million. You had a bad debt expense on the income statement of $26 million, but you wrote off accounts for $35 million. And there's some other things, mainly due to foreign currency translation. Some of these receivables are denominated in foreign currencies, which might go up and down relative to the dollars that PepsiCo reports in. So at the end of the year, the allowance for uncollectible accounts is $129 million. Subtract that from $7.153 million, and you get the net receivables, which agrees with the same figure on the balance sheet. But now you know a bit more. What I wish they would have told you is how much of these are accounts receivable, not formally signed or interest bearing, and how much of these are more formal notes receivable. One thing we always want to do, we want to be able to analyze receivables using ratios so we can compare PepsiCo's receivable ratios with itself over time or with other companies. So time series analysis, PepsiCo with against itself over time is one way to do that, and that's what we're doing in here. In the discussion post, you will be doing it cross-section, meaning PepsiCo against another firm. So you need this year's income statement and this and last year's balance sheet. So I've gotten these figures for you, and I want to point out some things. Your text says that the numerator for accounts receivable turnover is net credit sales. We just use net sales because it's the only thing we have. PepsiCo doesn't tell us how much of their sales are directly for cash and how much are on account. Since it really does mostly wholesaling, not direct to consumer, I would guess that most of its sales are on accounts receivable. For a company that operates its own stores, like McDonald's, they might have a lot of cash sales. Remember, even when a customer pays with a bank credit card like a Visa or MasterCard, that is considered a cash sale. So we have net accounts receivable at the end of 2017 and at the end of 2016. We are unable to break out the accounts receivable from the notes receivable, so we just take the total for accounts and notes receivable. You have to work with what you have when you're doing ratio analysis, and there's no further detail in the footnotes. We do this so that we can get an average net accounts receivable. In order to get the average net accounts receivable for 2016, we have to look either for the 2016 annual report, we look at the 2015 figures, or we could just go directly to the 2015 annual report of PepsiCo. I'm not requiring this that you do it for your firm over 2 years. I've done this for PepsiCo to give you an idea. So over time, accounts receivable turnover went from 8.55 times in 2017, when the year before it was 9.26 times. Would you rather have your receivables be collected on average 8.55 times or 9.26 times? Well, higher receivables indicate more efficient credit management and liquidity, other things equal. I'd rather collect these things more quickly. Remember, if you collect them 12 times a year, that's every 30 days, which would be, they said in the United States, that's their time they expect to collect the receivables, but that should be a little higher because internationally they have longer terms. So if we're looking at this, PepsiCo was less liquid in 2017 than in 2016 because PepsiCo in 2016 has a higher inventory turnover, or higher receivable turnover of 9.26 times. The average collection period, that's 365 days in a year divided by the average accounts receivable, or divided by the accounts receivable turnover. Like the accounts receivable turnover, it's a liquidity ratio, measuring the short-term ability of a company to pay its debts. However, it's going to be interpreted in the opposite direction. Higher receivable turnover, which we said is more liquidity, would lead to a smaller average collection period, waiting fewer days on average to collect receivables, indicating relatively more efficient receivables management. How does this work out for PepsiCo? Well, PepsiCo in 2017 had a lower account receivable turnover. Therefore, its account average collection period in days was 43 days with 8.55 accounts receivable turnover. Is this good or bad? Well, one thing you can look at it, and you can look at it next to what the terms of trade were. We said on average for its U.S. accounts, they expect to collect them in 30 days, but for international, somewhere between 30 and 90 days. So it doesn't seem outrageous, but we can look at it next to what happened in 2016. In 2016, we collected receivables every 39 days, so 4 days quicker. Using receivable turnover, PepsiCo was still less efficient in 2017 than in 2016 in collecting average receivables, making it less liquid. Took longer on average to collect it in days. So both ratios say the same thing. One is probably more intelligible to somebody who doesn't know a lot about accounting. So please feel free to review this presentation before looking at other companies' annual reports and posting to the weekly discussion board. Good luck. Get started, Jaspers. We use the average collection period, which is just another way of saying